My name is Roy March. I'm the CEO of Eastdil Secured, real estate investment bank. I've been there for 46 years now, so I've seen a lot of these trends come and go and a lot of the cycles. And I would suggest that we're in a remarkably good position relative to supply and demand dynamic. We do have, pretty vibrant demand on the rent side, low vacancies in general, again, with notable exceptions in the office space for commodity office itself. We are seeing improvements in the capital markets themselves. Rates are beginning to decline, spreads are beginning to decline, the risk factors are all on at this point in time, which we're thrilled about because the risk on indicates that we're going to have lower spreads along with lower base rates as time goes on, which is fundamentally a very good sign for the real estate sector itself. I would suggest that productivity is coming back into the analysis as to why people need to be back in the office, that it's virtually impossible to create culture, maintain culture, and really enhance productivity on a virtual basis, if you will. So our view is that that trend, that structural change, is going to go through some transition. We're going to see things that come out of the digital revolution that we're going through right now that ultimately will put people like the AI workers, if you will. These are knowledge workers in certain markets. You're already seeing in South San Francisco, for example, OpenAI that is taking a significant amount of space, as well as Anthropic, which is another AI group. And that's specifically going to happen, we think, in a lot of these knowledge markets. The difference between high-end commercial real estate and what we'll call more commodity real estate is the biggest it's ever been. So it's very selective as to where the return of office will be, and it's going to be a place where people come to because they want to be in a space that they feel comfortable in and they feel a part of their community. If one of the big trends, megatrends, I would suggest is the digital infrastructure space. The spend on AI and cloud is around $1.7 trillion over the next 3 years. And the issue is really, can you fund not only that amount of demand in terms of delivering data centers? It's a question of, can you deliver the power, because the power is the pinch point and jurisdictions matter, the amount of power matters, ultimately the reliability of delivering for these, and call them the magnificent seven or the big five, if you will, if we're in the space, looking at cloud revenue and looking ultimately at AI revenue. There's a question as to whether there's enough capital availability in the infrastructure space as well as the real estate space to fund the development and ultimately to take out all these, because these transactions are large in scale, and so there's a concentration risk that's associated with that virtually everybody in the industry is prepared to or is anxious to solve at this point in time. All in all, I think that we're excited about the fact that rates are coming in, spreads are coming in, which make things a little bit more manageable relative to refinance risk. Obviously, the banks are very, very full relative to their commercial and real estate loan exposures. We've lost a big chunk of the regional bank market as a result of where interest rates went so quickly and compromised their portfolios. And they've been the driver in a lot of small business, which drives the economy at the end of the day. And they've been very much a participant in syndication with the larger banks, as well as funding local, regional, industrial, and multifamily in particular. So that sector of the market was really, really tough right now. The banks, I think, will be back in the market sooner versus later, but they've got to absorb some of the losses in the restructuring that they're doing. But hopefully they'll be back. But the CMBS market is wide open. The insurance companies are wide open. The agencies are wide open, obviously at a higher cost today than we saw them a year ago. I think QT is going to burn itself off, hopefully in the next 2 quarters, where they're going to pull back because they can. And I think that with the election year coming up, even though the Fed isn't political, hopefully we'll see some rate relief and we'll see some relief in the liquidity.